Hey everyone, thanks for being here. Today we have a personal finance boot camp run by Tyler from Wealthfront. So I want to pass over the time to him.
Sure. How's it going, everyone? My name is Tyler. Good to be here with all of you. Like she said, I am happy to share some thoughts I have around personal finance. And before we get started, I want to just give you a standard legal disclaimer that we're going to talk about things that I think are very valuable, but you should consult with a professional before you make any major financial decisions. This is they forced me to put this in here. But otherwise, I want this to be incredibly informal and allow you to ask as many questions as possible. So over the next, say, 20 or 30 minutes, I want to cover three things. I'll do a brief introduction and kind of tell the story of how we got looped in with Lambda. I break it down into 10 commandments of personal finance. And then at the end, I'd love to answer any questions about anything, whether that be personal finance, investing, anything of the above. Myself, happy to talk about it. And jump in anytime with comments on the Zoom if you have them, and we'll stop and answer those along the way as well. No worries at all. So a little bit about me. I work at Wealthfront. Wealthfront, if you're not familiar, is an automated investing service and financial planning service based in the Bay Area. So I live in Redwood City. I graduated a few years ago from Cornell with an MBA, and then in undergrad I went to this small state school in southern Utah called Southern Utah University. I call it the MIT of Southern Utah. I'm weirdly passionate about personal finance. I took these tests called the CFA, which is kind of like a graduate degree in investing and in finance. And lastly, maybe most importantly, I'm a big fan of Lambda. So for those of you who aren't aware of how this conversation came about 2 months ago, Austin sent out a tweet that said that he would love to help the students of Lambda who are getting ready to prepare for high-paid technology careers better understand how to think about personal finance and investing. And as a product manager here at Wealthfront, I actually run our Twitter account. And so I saw that, and I knew Austin already. We're both from Utah. And I replied immediately and said, hey, how can Wealthfront help? And so about a month ago, we had a blog post, kind of a joint partnership announcement where we highlighted Lambda and the mission of the school and some of the talented students. In fact, I think we spotlighted 3 students, and that's kind of what brought us here today. So this partnership between Lambda and Wealthfront, we're very excited about for 3 reasons. Number one is we believe in the mission, and we think that there's a selfish component to it. We think there's going to be some graduates that are going to be great Wealthfront engineers eventually, and we'd love to hire some of you. That's the selfish component. Number 2 is we'll be able to give ongoing education. Like if you find this valuable, we're happy to do this every quarter or every 6 months so that future classes or cohorts of Lambda students can also get this advice. And then number 3, we're going to offer Lambda school students kind of a deal, a special partnership that you can get your first $15,000 managed for free if you decided to use Wealthfront. Now, that being said, that's basically all I'll say about Wealthfront with a few exceptions. This is not a Wealthfront talk. It's a personal finance talk. And regardless of what you end up deciding to do, these principles should be applicable to you. So let's jump into it. So why personal finance? Why are we talking about this now? As it turns out, you're going to see 10 commandments here, and all of them are pretty simple to understand. This is not PhD level stuff. What you're studying at Lambda is much harder than personal finance, but it's not really easy to do. Money's kind of difficult, and it causes stress. But if you get these right, you'll have better marriages, you'll be better parents, you'll be better students at Lambda, you'll be better employees. And so what you'll see in the following pages are 10 very practical, very simple rules that if you follow, it will put you in the top 1% of personal finance literacy in the country. So that's kind of the promise that I'll make. 10 rules, you follow them, and you'll know more than just about anybody, and you'll be more equipped to succeed if you do all 10. So let's just do it in one screen. Maybe about a year ago, I tweeted this out. It's from the Reddit personal finance group, but this is personal finance in one screen. Take a second to look at this, but really what you do if you set yourself up for success is you create an emergency fund, You then match a 401k, which we can talk about what that even means by matching. Some of you, this will be a review for. Some of you, it may be new for. So I apologize if this is lower or easier than maybe you expect. Then you should pay off debt. Then you should take advantage of special accounts called IRAs. Then go back to the 401k because there's some advantages to that before you save in a taxable account. And of course, you have to fit in your expenses in here too, but this is just the savings component of personal finance in one screen. So let's break down the 10 commandments. We're going to walk through each of these one by one in just a few minutes. I don't think this will take very long, but it's basically breaking out this one screen into 10 different rules with a few principles wrapped around them. So we're going to start with emergency fund, then we're going to pay down debt. Then you match a 401k, which you'll see why that's a duh. IRAs come after that, then taxable accounts. If some of this makes no sense to you, don't worry. We're going to break it down. And then on the right side, when you do invest passively. We'll explain what that means. Automate, pay off credit cards, use debt sparingly, and then buy life insurance, but not the kind that your high school buddy is calling you about. It's called term life insurance. Well, let's break it down. Let's start with the first one. So let's go to an emergency fund first. So the question is, if something happened to you tomorrow, significantly, you got injured, you went skiing, you broke your back, you couldn't work, could you live off of your savings? It turns out this question is asked quite a bit. And you'll see at the bottom this stat from the Federal Reserve, 44% of all respondents, this is nationwide, couldn't come up with $400 if they had to. They wouldn't be able to come up with $400. So when I say emergency fund, it's a fund that allows you to live off of in emergency situations. It's not a spending fund. It's not towards a car. It's emergency. And you actually build it, and then you never touch it, ideally. And that's hard to do because when you have cash, you want to spend it. But you build it and you never touch it. So how much? Most financial experts recommend 3 to 6 months of your income. So if you're making $5K a month, you should probably consider at least a $15,000 emergency fund. If you're going to be a Lambda School graduate soon and maybe you'll make closer to 10K a month or 9K a month, you can do the math there. Now let's actually get to the practical advice. Where should you save it? There are some online savings accounts that do a pretty damn good job of getting you set up with an emergency fund. For example, gsbank.com, that's Goldman Sachs Bank, Ally, American Express Savings. These are all online banks. And because they don't have like physical branches, they have much lower cost structures. And that allows them to offer you, say, 1.8% on cash. And that's FDIC insured, meaning it's just the same as you go to your Chase Bank or your Wells Fargo Bank, except Chase and Wells Fargo pay you 0.01%. They pay you nothing. These guys will pay you 1.8%. So I want to emphasize this is free money. Use GoldmanSachsBank.com, 1.8% free money for taking no risk. It's FDIC insured. This is one of the only free lunches in all of finance is a high yield savings account because of that FDIC insurance. These are 3 of the most popular ones. So you should start to build up your emergency fund first before you do anything else. And whether you start with a 1 or 2 month and then move on to other things and then come back and top it off later, that's a different question. After you've done that, you then pay off debt. And this should probably say pay off debt next. So when I say debt, what do I mean? I mean high interest debt. You can probably earn around 5 to 7% investing. So high interest debt means anything above that, kind of as a rough rule. What would fall into that bucket? Credit card debt, 16% on average. It can be much higher than that. So the question you should think of is, what if I came to you and said, I can give you 16% if you invest this money, guaranteed? Well, that's a no-brainer. There's no investment product that offers this, as you see at the bottom, in the world, and so you should accept that. That's equivalent to you paying off your credit cards. You're getting a 16% return on your money in the form of not having to pay 16% interest. It's the power of compounding. If you pay it, you're in rough shape. If you receive it, you're in good shape. So number 1 and number 2, build an emergency fund, pay off high interest debt. If you do those 2 things, all of a sudden you're really at the top 20% of probably Americans or people throughout the world who are set up for financial success. Now, this third one is kind of interesting. Some of you are going to get offers from companies that offer a 401k. For those who maybe are totally new to this, what is a 401k? It's a retirement savings account that has to be offered through an employer, so you can't go get it by yourself. And they usually partner with something like Fidelity or some of these other big investment companies to offer you a 401k through your employment. Now, that's good in and of itself, but it's not necessarily great. What's great is if they offer a match. A match means that if you put in $1, your employer will also put in $1. And they do this because they want to incentivize you to save more, because good employers want you to be successful outside of work too. And so not all companies offer a match. It's probably more common in larger companies. For example, Wealthfront doesn't have a match today. We're still a startup. But some of you may get offered a match. If you have that option, take it. It's 100% return on your money. If you deposit $1,000 into your 401k and they match it up to $1,000, you should match it. So this really is an intelligence test. I've had a joke like the CEO should probably find out which of her employees are or are not taking the match and then promote the ones who are and maybe fire the ones who aren't. That's a joke. But for real, it's 100% guaranteed return. You should take this if at all possible. After that, after you've matched your 401k, there's another special account called an IRA. This can actually be opened by you regardless of who your employer is. It's an individual retirement account. And there's two types of them, traditional or Roth. Younger professionals often choose Roth, and the main reason is because it's based on tax rates. If you believe your future tax rate will be higher than your current tax rate, Roth actually makes more sense because you're untaxed in the future. Whereas a traditional, you're taxed now but not in the future. I've put a link here, and I'll share the slides out that you can read more, but there's plenty to learn. The simple is that you probably should open a Roth IRA, and you probably should max it out every year. That's $5,500 a year or $458 a month. So the reason you do this is because it's going to grow tax-free, and this is a much better option than just a regular brokerage account through, say, Robinhood or Scottrade, because regular brokerage accounts are taxable. And IRAs are not. They have tax advantages that these other ones don't. So we've worked through quite a few of these things. We started with emergency fund, 401k, debt. We're now at the IRA section, and you can do up to $5,500 there. You can then go back and fill up the rest of your 401k, even the part that's not matched, up to $18K. And then finally, let's go to a taxable account. This is just a regular brokerage account through Robinhood, Scottrade, Wealthfront. All brokerages offer a taxable account. Some of them offer IRAs as well. There's no limits to how much you can contribute. There's no limit on how much income you can have, but obviously you pay taxes on the gains. So hopefully it's clear why you should only put money in a taxable account after you've maxed out all of these other things like the retirement, 401k, and an emergency fund. This is kind of the last resort, and hopefully your incomes allow you to save money into a taxable account. And if you're able to get this far, this is a very good sign. After you've done a taxable account, the question is, all right, so you're telling me to open accounts, Tyler, but you're not telling me what the hell to do with these accounts. How do I actually invest? What do I put in them? There are so many options. I could go buy Facebook stock. I could buy these things called ETFs. What's a mutual fund? Well, the good news is that there are services like Wealthfront that'll do this all for you. But you have plenty of options to choose from. Regardless of what you do, my recommendation is to invest passively. What do I mean by passively? I mean that there's two ways to invest. Active investors are kind of like stock pickers. They say, I have an opinion that Facebook is going to outperform the broader market, which, by the way, has been true. But if everyone believes that's true, Facebook's stock price goes up, and all of a sudden it doesn't outperform the market moving forward. There's passive investors who say, I don't have strong opinions about what's going to outperform or underperform, so I'm just going to buy the market. Buy the market means you buy the whole pot full of every stock, and you own a little bit of every stock as opposed to betting on one stock. You're not stock picking, you're just buying the market. And fortunately, those who just buy the market by investing passively end up over time with somewhere around a 5 to a 9% return on average over the last 70 years. And if they just buy the market and let it sit, they end up outperforming active investors. Let me tell you a little bit why. There's this famous book called A Random Walk Down Wall Street, and there's a famous example from this book where Burt Malkiel says he takes the stock picks from some of Wall Street's brightest stock pickers, and he compares it to a chimpanzee throwing darts against the wall. And they throw darts against the wall, and wherever the dart lands is the stock that they pick. And it turns out the chimpanzees and the professional stock pickers don't do that different, and in some cases the chimpanzees outperform. The market is really good. The poker table is pretty efficient. These poker players that you're up against are studying these stocks all day long. And so if you're saying I'm going to download Robinhood and try and be smarter than them, there's a high likelihood that you're the person at the table that doesn't understand the game as well as they do. So when I say invest passively, the short answer is buy the market through low-cost ETFs like the S&P 500 and let it sit. We're actually going to do a couple slides on this one, though. Some of you may be skeptical of this, and everyone is. They say, well, I can beat the market. If I would have just bought Facebook, I would have outperformed. And you're right. But Facebook had a lot of ups and it had a lot of downs. It dropped by like 30% in the first month after the IPO. And odds are you probably would have sold when it was down, which is not what you should have done. So there's a lot of evidence that these stock pickers actually don't beat the market themselves. So as it turns out, you as a completely passive, non-professional investor can actually outperform the professional. This is one of my favorite quotes from Warren Buffett. The ultimate irony of investments is that there's no question that an obstetrician will deliver babies better than a husband or the wife. And if you go to the dentist, they will remove teeth better than the patients do it themselves. But in the investment world, someone who believes in American business and seeks out the lowest way, i.e. the passive way, to participate and does it consistently, will actually achieve results that exceed the investment professionals. It's the only industry I can think of where, say, a student from Lambda, a product manager from Wealthfront can actually outperform the professional. The layman can outperform the professional. It's very weird to see this, but you can. So last one on investing. So a lot of people will ask, all right, so what do I do when the market goes down? Trump got elected and the market dropped pretty big that first day. You do nothing. Why do you do nothing? Because you're invested for the long term. And when you're invested for the long term, like 30 years, you just don't care about short-term market changes. What do you do when your uncle tells you to buy Snap's IPO? You do nothing because you have a recurring deposit set up that invests passively, and you just set it and forget it. And this is really hard advice to follow. In fact, most advice in finance and investing is counterintuitive. But those who just set it and forget it actually outperform. This is one of the only times I'll mention Wealthfront. This is how it works. You sign up to Wealthfront. We ask you like 5 or 6 questions, and then at the end we tell you that you have a risk score of 8 out of 10, which usually means you're younger because you can take on some more risk. You make a deposit, and we handle the rest. You buy all the ETFs correctly, and you're invested in the market, not in just stocks individually. This last principle is pretty important too. Try and automate and use technology wherever possible. So for budgeting, I actually still use mint.com. It allows me to see all of my transactions with my bank. There's some newer ones as well, like Empower. Plenty of others trying to kind of take over Mint, but it's kind of stood the test of time. It's not phenomenal, but it's pretty good at what it does. And then to automate your savings and investing, this goes back to the 401k. You should set up a direct deposit. How that works is you actually end up paying your 401k out of your pre-tax dollars, and you're paying yourself first before you say pay for cable bill or your groceries. You pay yourself first. You set up recurring deposits into your IRA and your taxable accounts, and this is again where Wealthfront can automate it for you. Betterment is another example of some of you might have heard of. A lot of people use it to automate their investing. This is very closely tied to the second commandment of paying off credit card debt, or paying off big high interest debt. But on an ongoing basis, if you use credit cards, which, by the way, I do, I actually try and use credit card purchases for everything I can because I get free flight points, and I can fly to Paris for free like we did last month because I have points built up over the last year. But the key point here is that you have to pay it off every month. About 40% of people don't do that, and that's not a smart move. Back to the 16% interest that you're being charged to do that. So just spend what you would have spent using a credit card and then pay it off every month. And in that case, you're actually not paying any interest and you're getting the free points and you're better off for it. Finally, all right, so when do I use debt? You're telling me not to use credit cards. That makes sense. But when should I use debt? Historically, there's probably 2 or 3 really good uses of debt. A home's the most common example. An education is the most common example. But I know who I'm talking to here. I'm talking to the people who are smart enough to not even have to go into debt and are getting a world-class education through Lambda. So the only other one I can think of is perhaps you need debt to buy a car because you have to have a car to get to work. But if at all possible, you should try to avoid going into debt for a car as well. Save up maybe increase your emergency fund and do a second one just for a car fund. Don't touch your emergency fund. Save up for a car separately. But a home and sometimes education is the right time to use debt. By the way, worth a congratulations to each of you for making the choice to avoid debt and still get a phenomenal education through Lambda. It's pretty amazing. This model is the model of the future, no doubt. The last one's kind of interesting. So I actually do recommend, and most financial advisors do recommend, that you should probably have life insurance. This is especially true if you have a family. If you're married, if you have kids and something were to happen to you, it's important that you don't leave them high and dry if a catastrophe were to happen. Now, there's kind of 2 options here: whole life insurance or term life insurance. The best option here, in my view, and in the view of many other advisors, is to just simply buy term life insurance. Term life insurance means you're insured against death for a certain term, for 15 years, 20 years, 30 years, 40 years. And that's the purpose of life insurance. Whole life insurance becomes a little more complicated. They try and tie an investment product together with an insurance product, and it's unfortunately pretty expensive. It's not the best way to invest. You can invest the way we just talked about earlier, where you set up your IRA and you automate a recurring deposit and you buy low-cost passive ETFs. You do not need whole insurance to do that. It's pretty expensive. So that is it. That is the 10 commandments of personal finance. And I want to show you the whole screen just so you can see them at one time. I want to repeat, if you guys do all 10 of these things, you are top 1% of personal finance users in the country and probably in the world. Most people don't do all of these. Most people don't know about all of these. But it's as simple as this slide and this slide. You do these 2 things. It's simple, but it's not easy. So with that being said, we only took about 20 or 25 minutes. I would be happy to answer any questions now, or you can email me or reach out on Twitter. Anything I can answer now while I have you.
So where would you suggest, if we wanted to have a financial advisor, where would we find someone that would be a good fit?
Good question. So like a human financial advisor, I assume you mean, right?
Yes. Okay.
Good question. So that's a question many people run into. Like, I really want a human to help me through a traditional financial advisor to help me through these decisions. And in order to find that, I mean, you can hire a traditional financial advisor through, say, Wells Fargo or Chase or Raymond James. But there's one problem with that, and it's the reason Wealthfront actually exists. Most of these financial advisors require you to meet a minimum, like an account minimum. And usually the good ones require a minimum of up to $500,000. So most people like you or I don't have $500,000. We're just starting our careers. I'm 32 years old. I have some savings, but I can't meet the minimum to hire. Some are as low as 100K, some 50K. But regardless, the good ones have minimums because they actually want to work with the most wealthy clients. So we, as like people who are growing our wealth over time, are kind of left high and dry. There's not a lot of great options for a personal financial advisor. Now, that's why Wealthfront exists. We're trying to take everything that a traditional financial advisor could do and put it into software. So for people who don't want to talk to a human, who really would rather just deal with an app, that's why Wealthfront was created. But we know that, like, we have a bunch of people who say, I'd rather talk to a personal financial advisor, a human financial advisor, because I need someone to talk to over the phone so I can trust. And to that, Wealthfront says, great, that's fine. We know that exists, and you're probably just not a good fit for Wealthfront. But a lot of our clients tell us they pay us not to call them. They don't want to have a Skype session with us. They don't want to call us. They want us to do it through the app, and they want to interact that way. So again, I don't need to get into Wealthfront specifically, but the unfortunate answer is that it's hard to get a good personal financial advisor until you have a certain amount of money.
Awesome. Thanks for that.
No problem. Anything else anyone's wondering?
I've got a question.
Yeah.
I'm an instructor here, and personal finance does not escape anybody. Just so everybody knows, we all got to be aware of these things.
Yep.
So sometimes I think people see these things, and you just went through and said, look, even the experts get this wrong, and like the Robinhood example you gave, and then you read all these books, and these books are like, you can do it. You can invest better than the experts. You've seen patterns over and over and over. Like you just described those patterns. Can you explain or give an experience of when maybe in your own personal, or you've worked with a lot of people and you can anonymously say, here's an experience where they tried to go big, they got burned, and the market was better?
Yeah, I mean, I have like dozens of these experiences, right? So if Austin was on the call, I'd kind of tease him a little bit, but he got written up at one point because he tweeted at Elon Musk that he had put his life savings into Tesla stock, and it worked out for him. Tesla stock went up. But there are countless other individuals who try and pick a stock. Look, actually, let me back up. The simple math is that at that poker table, whenever you make money, somebody else has to lose money. It's a zero-sum game when you're trying to outperform the market. The market itself isn't zero-sum because it goes up over time. But the zero-sum game happens when you try and play the outperformance. So there are plenty of people who bought Snap stock at the IPO and it collapsed. I have a best friend who bought Snap, put a significant amount into it, and it collapsed. Instagram ate their lunch, and the market wasn't quite sure how to handle that. There's hundreds of other examples, but the principle behind that is, do you actually know more than the person at the other side of the transaction? Because when you're buying Snap stock, someone else is selling it. And do you know more than they do? The odds are you likely are trading with someone who has done more research into this than you have. And you're actually at a disadvantage as a result. And then you look at the math. The math shows that because active investors charge higher fees, you're paying someone to, say, a mutual fund where they pick stocks for you. And even in Robinhood's case, even though it's free trading, you actually pay something called payment for order flow in the background. You end up you're worse off than you would be if you just bought a passive ETF and let it sit. Good investing is boring, and a lot of people don't like hearing that. It's very, very boring.
So thank you for answering that. And in addition to that, with Wealthfront, you say you're a startup. Doesn't that scare me as a consumer? Just like Lambda School scares new consumers as well, since it's a startup.
Yeah, good question.
I've startups my whole life, so I'm tongue in cheek here. But Wealthfront, if they're investing and they've got these investments of my money, obviously companies usually have exit strategies or something.
Sure.
What does that look like? Like if Wealthfront goes out of business, do I lose my investments or do I just stop making payments?
Yes, good question. So there's two things I'd say to that. Number one is that we now manage $11 billion. We have 220,000 clients. and we doubled in size last year. And, 11 billion puts us in like the top 2% of size of asset managers in the world. So we're actually pretty big now, even though I say startup, because when you compare us to who we want to be, we're just like 1% of the way there. So, but that doesn't fully answer your question. Now, let's say Wealthfront did go out of business. You have what's called SIPC insurance. What it means is that you're guaranteed to get your money back out of our account if we go out of business. To be clear, that doesn't insure you against loss in the market. The market goes down, we have no control. It insures you against loss of Wealthfront going out of business. So that reassurance is there.
Awesome. That is exactly what I wanted to know. Thank you. I'm really interested in Wealthfront now.
No problem. I saw one chat as well for those of us who have student debt. Do I have particular tips in handling that? Good question, and I should probably add that to, one of the rules. Let's go back to pay off debt first. So when we talk about this, I actually have student debt too from the MBA program I went to. So what I did, number one, is I refinanced through SoFi, and that got it down from the federal rate, which was about 6 or 7%. SoFi is now 4%. So that was just, a no-brainer. Now that I'm at 4%, you could make an argument that I should just pay it off month to month because you can earn more than 4% in the market by investing it. However, I really place a premium on getting out of debt, as I'm sure some of you might agree with, which is why you're at Lambda in the first place. And so I'm not actively contributing to an investment account right now. I am paying off debt. So even though my rate is 4% and it technically isn't high interest, I sleep better at night when I'm out of debt. So I'm paying off that as well. And I think you should aggressively pay off debt. And you can reason that if it's lower interest, like say 0 to 5%, you don't have to do it as aggressively. Then it becomes a personal preference. Definitely look into SoFi though. The rates are usually much lower than the federal loans. And then again, kudos to you guys for not getting into student debt through Lambda. Looks like that's it. Any other last questions?
I have a question.
Yeah.
So I've heard you mention, I believe, Robinhood a few times.
Yeah.
So for someone who's looking to, begin the investment process by either getting a ETF, would you say that Robinhood is the best option for, buying these ETFs for the least transaction fees?
So my question would be, have you first fully maxed out an IRA? Because if you haven't, you should not use Robinhood. You should max out an IRA. Again, taxable accounts come last. You should not be investing in taxable accounts, which is what Robinhood offers, until you take advantage of the tax-advantaged accounts. And I know this is painful because I have a Robinhood account too. I use it, and IRAs are a lot more boring. But it makes a lot of sense to max out your IRA before you're buying things through Robinhood.
So if I want to start with an IRA, what would be the best way to go about, getting the IRA secured? Would it be going through Wealthfront?
Wealthfront.com. Yep.
Okay.
Wealthfront.com. Look at Betterment too. They're our main competitor, but Wealthfront.com will set up your IRA for you, help you get a recurring deposit, and then we invest for you. We choose the ETF, we rebalance it for you, we reinvest the dividends, and you're truly investing passively. Not the only option. You should look at Betterment. You should look at Fidelity or Schwab. Obviously, I think Wealthfront's the best option, but that's where I would start. We also offer taxable accounts, and you can do that here too. In fact, the majority of our clients have a taxable account, and I would recommend that over a Robinhood taxable also.
Excellent. Thank you so much.
No problem. Thanks, guys. I hope this is helpful. I'm happy to hear feedback as to what rules you agree with or disagree with, or maybe you already knew all of these things, or I would love to know what was valuable and what wasn't so we can make it better for next time.
Awesome. Thank you so much for taking the time today, Tyler, to educate us on this. This is amazing information. I'm going to have Tyler send me links and contact info, and I'll drop that in Slack for everyone. But for now, we'll just say thanks for coming, and we will talk to you all later.
Thanks, guys. See ya.
Thanks. Bye.